when I talk about the valuation, there's the valuation if you're going to sell to outsiders. And then there's the valuation that you would sell to insiders. If the insiders are non-family, guess what? The price might be a little bit higher than if you're selling to family. But the valuation dictates how the whole economics of the buyout come together. The second thing is the retirement income needs of the sellers. If the owners were used to getting $200,000 a year and they retire and they get a buyout that's paying them $150,000 a year, and at the end of 10 years it's gone, then in year 11 plus, they're going to see an elimination of income, and they better make sure they have other assets in their financial statement that are going to carry them, because the cash flow they're getting from the company is pretty much gone. If the valuation's too high, you can really screw up the buyers. If they're sons and daughters that are in the business running and operating it, you can end up having installment payments that are way too high, right? If the price is too low and you start paying installment payments to the seller has to pay capital gain tax on the principal that they're getting from the buyout. They've got to pay income tax on the interest portion of the buyout. And they could get to a situation where they're out of money by year 11. So it's a balancing act. I'm just going to write that down. It's a balancing act between the valuation and the retirement need of the sellers. Okay, so what a lot of this comes down to is cash flow management. How do you manage the after-tax cash flow of the company so that you're able to retain the money that you need to be able to operate the business, to have the working capital, and at the same time, make sure you can afford to pay these installment payments to the shareholders? Now, you are able to get rid of their salary, so that helps a lot. But you still have to do the mathematics of what it looks like. And so that means that you got to build models that basically show you the before and the after, what things look like before you do the sale and what things look like after, and then run different variables. One of the things that we like to do with the sellers is to look at their personal financial statement and then help them put together a retirement budget and get an idea of what their investments look like and what kind of income that can come off of those investments in retirement, so we can get an idea how much the buyout needs to be able to keep them in the lifestyle that they want. But it takes some real work. And oftentimes before we even do the transaction, we study the need that the owners have for cash flow, so we get an idea what that benchmark needs to look like. Then we look at the cash flow management of the company and say, what's really left over after business expenses, after paying for the current executives and the executives that you have to hire to replace the owners that are selling? What does the net cash flow look like? How much of it do we need to retain and keep on the financial statement to provide stability in the company, and how much we can give up to provide for the buyout? So these two things have got to come together. And it's not something that you can just sketch out on a notebook pad. You got to build all this into a model so that you can forecast how this thing all plays out.